How's it going? I'm Jason, I'm your host. Welcome to the Week in YouTube Finance.
So what if I told you that Japan, a country with just 2% of the world's population, could disrupt the entire world?
Japan's government has released growth data for the first quarter of this year. And the numbers show the economy has taken a step back.
Japan's three biggest names in the auto industry announced disappointing numbers for the last quarter of the business year, and they're warning of rough waters ahead.
Rice prices in Japan remain stubbornly high. Consumers are struggling to put food on tables and retailers to put products on shelves at affordable prices.
The government has been trying to fix the problem with limited success.
Now, you probably don't spend a lot of time thinking about Japan's economy, and most people don't. It's on the other side of the world, and it's not in the headlines all the time like the US or China. But the reality is that Japan could increase interest rates in your country, crash stock portfolios all over the world, and potentially even trigger the next global recession. Because Japan is not just another country. It is one of the biggest creditors on earth. It holds over $1 trillion in US government debt, and for decades, it's been the engine that powered some of the world's riskiest financial bets through something called the yen carry trade. And the yen is one of the most important currencies in the world, and it's also getting stronger. Now that sounds like a good thing, but it's actually not. And we found out why it's not last year in 2024. That's when we saw the carry trade unwind, which led to a quick spike in the yen, which led to a flash crash in Japanese stocks and a ripple effect that hit everything from US stocks to Bitcoin and more. Now, at the time, the Bank of JP Morgan was warning that the carry trade unwind was only halfway done. And now in 2025, that unwinding is continuing. The Japanese government bonds are collapsing in value, long-term interest rates are going up, and bond auctions are failing. And because of that, we're seeing this slow motion unwinding of trillions of dollars in global leverage, and investors are starting to feel a little scared. But the thing about this story is that it's not just the story about Japan, it's a story about the end of an era. The era of easy money. And as Lynn Alden puts it, when the global debt is this high and the demographics this broken, there's really only one way out: currency devaluation and the gradual realization that nothing stops this train. Now, once that happens, money starts to look for other places to go, like scarce, decentralized, hard assets that can't be inflated away. So in today's video, I want to explain exactly what's going on behind the scenes, why it all matters, how it's all connected, and how I'm personally investing. So with that said, let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for Japan. Now, before we get into the super interesting details, let me first talk about something that rarely gets talked about, which is demographics. Now, demographics explain the age structure of a country, like who's working for the money, who's spending it, and who's retiring with it, because there has to be a balance. Now, when you get less young people in a country, you get a smaller workforce, slower economic growth, lower tax revenue, and at the same time, the cost of things like healthcare and retirement go up. In other words, if a country has bad demographics, they will probably have a bad or a weak economy. Now, Japan happens to be the oldest country in the world. About 30% of its population is over the age of 65. Its birth rate has been below replacement for decades, and it's been getting smaller since 2008. And by 2050, they're estimating that Japan is going to lose around 20 million people, which is the equivalent of about everyone in Florida. And the aging crisis doesn't just affect retirements and hospitals, it affects the entire economy. And that's because less workers means less growth. More retirees means more government spending. You get the idea. The only way to keep that kind of a system running is to borrow money, which is why Japan now has the highest what's called debt to GDP ratio in the developed world, which is over 260%, and it keeps going up. And for years, Japan has gotten away with that. The government could just borrow trillions without any consequences because Japan also had their interest rates at basically zero, and because the Bank of Japan was willing to buy up half the bond market. But Japanese investors still wanted to make a return on their borrowed money. They wanted to park that money somewhere, so they bought US assets, which is why Japan became the biggest foreign holder of US treasuries. But now, in 2025, that balance is starting to break. The Bank of Japan is walking away, and all of that debt is starting to make a huge difference. So the question is, why does Japan's economy matter if maybe I live in another country? And let me explain why it should matter so much to the entire world, and why the market around the world was actually benefiting from Japan all along, whether we knew it or not. Because for decades, Japan has been the world's biggest, what's called creditor nation. It holds over $3 trillion in net foreign assets, and it's the top holder of US Treasury bonds, with over $1 trillion in US government debt as of 2025. And it's not just bonds. Japanese institutions also owned US stocks, corporate debt, and even real estate. All the money that was leaving Japan has actually helped finance deficits, help asset prices, and lower interest rates in the US and all around the world. And the reason Japan could do that, the reason it had so much spare money to send overseas, comes down to one thing. Interest rates were stuck at zero. This created one of the most important financial cheat codes of the last 30 years. It's called the yen carry trade. Here's how it works. Investors, hedge funds, and big institutions borrow money in Japanese yen at ultra-low interest rates. Then they convert that yen into dollars, euros, or other higher-yielding currencies, and then they invest that money into assets overseas. And that could be anything from US stocks, emerging markets, bonds, crypto, real estate, you name it. Now, the difference between Japan's almost zero borrowing cost and the higher return almost anywhere else becomes free profit. Multiply that by billions or even trillions, and you start to see why this trade has been called the global money glitch. For example, in 2023, US interest rates were over 5%, while Japan's interest rates were still negative. And that created a huge incentive to borrow cheap yen, buy US assets, and make the spread. At its peak, Bloomberg estimated that carry trades involving the yen had reached hundreds of billions of dollars globally, but here's the catch. This only works as long as Japan's interest rates stay low and the yen stays weak. If the yen gets stronger, or if Japanese interest rates or yields go up, the trade starts to break. Borrowing becomes expensive, and then currency losses start to go up. And all those investors have to sell their US assets to cover the damage. And that's exactly what started to happen in 2024. The Bank of Japan raised interest rates for the first time in decades. The yen went up more than 10% in just a couple weeks, and what followed was pretty bad. Japan's market lost a ton of money in just 3 days, US stocks sold off, Bitcoin went down, and JP Morgan was warning that the unwind had only just started.
People are like, this carry trade, which seemed like the easy trade, is no longer. So you start exiting fast and it starts to be self-fulfilling, unwinds and unwinds and unwinds.
Now, in 2025, the Bank of Japan is still tightening. Japanese bond yields are going up, and the yen is starting to get stronger, which means trillions of dollars in global leverage are again at risk of unraveling one margin call at a time. And now, for the first time in decades, Japan may not just stop buying US treasuries, they might start selling them. And that brings me to what's happening in Japan's bond market right now, which is not good. In May 2025, the yields, or interest rates, on their 30-year government bonds hit over 3%. The 40-year bonds are at 3.6%, an all-time high. And that might not sound like a lot if you're used to US interest rates, but for Japan, this is historic. These are supposed to be the safest, most stable bonds in the country. And now investors want a huge premium just to hold them. In other words, they want more interest. Why? Because their trust is fading. Japan's debt to GDP, again, is 250%. And for years, the only reason that didn't cause a crisis was because the Bank of Japan could print money to buy up those bonds. That works until it doesn't. And now that the Bank of Japan is backing off, the market is testing what their bonds are really worth organically without that artificial government demand. And what the whole world just saw are failed bond auctions. Investors are not bidding what they're worth. So how do you get those people to buy up those bonds? You raise the interest rate. It's the only way. By doing that, though, you break the carry trade, and we're seeing some of those effects kind of spill over into other parts of the market. Enter Metaplanet, for example. Metaplanet is a very popular publicly traded company in Japan. They own thousands of Bitcoin. And over the last few weeks, that stock has exploded, mostly because investors are treating it as kind of a nuclear hedge against Japan's bond market collapse. Why that matters, though, is because as Japanese interest rates go up and their yen gets stronger, there's shorts that are placed on Metaplanet and Bitcoin-related strategies, and those started to see huge losses. So what we saw was kind of a short squeeze. When people lose trust in the government's ability to manage their debt, when they see their long-term bonds, which are supposed to be boring and safe, acting like volatile tech stocks, then people start to question the entire system. And in Japan, some of that money is moving into Bitcoin, not necessarily directly, but through companies like Metaplanet and Michael Saylor's strategy. But what I really think this strategy is about for them is a move away from assets that are controlled by central banks towards assets that are finite, decentralized, and immune to yield curve manipulation. Now, I'm not saying that Bitcoin is going to replace the yen or anything like that, but what I am saying is it shows you just how fast emotions can change when a country's safest asset starts to get a little wobbly. Because if Japan's bonds are not as safe as they used to be, and the central bank is out of ammo, what's Japan supposed to do? Now, before we keep going though, let me just zoom out for a second, because everything I talk about on my channel is from interest rates to inflation to investing, but it really comes down to one thing: financial freedom. And a huge part of that is understanding how credit works and how to build it in a smart, sustainable way. That's actually why I wanted to mention Kickoff, and now let's get back to it. So besides the yen carry trade coming to an end potentially, there's a second idea people are really scared of, which is, what if Japan starts selling US treasuries? Remember, Japan is the biggest holder of US government debt with over $1 trillion. And for years, that has actually helped keep US interest rates low and help support our huge government spending. But now, some Japanese institutions have already started pulling back from foreign bonds, which includes buying US treasuries. As Japanese interest rates go up and the yen starts to get stronger, it gets more expensive to borrow. So instead of borrowing money, that money is just going to stay at home. And if that trend continues, the US could actually lose one of its biggest lenders. And that would mean huge borrowing costs here in the US for consumers, and more pressure on the Fed, and even more volatility in the bond market. And you could start to see a world where interest rates in the US actually go up, not because of inflation, but because creditors just don't show up to the auction. Even the Japanese finance minister said recently their US Treasury holdings could be used as leverage in trade talks. Now, he then later was like, just kidding. But it shows you that it's actually a real possibility. For now, the Bank of Japan is under a lot of pressure. They have over 1.3 quadrillion yen, or 260% of GDP. That means even a small increase in interest rates could have a huge consequence. If Japan's interest rate goes up by 1%, for example, that alone would add about 13 trillion yen, or $85 billion in yearly interest payments. That's more than what Japan spends on its entire defense budget for the entire year. So besides selling US treasuries then, Japan has two options, and none of them are good. Option number one, raise interest rates to fight inflation and protect their currency. But that risks blowing up the government's budget. It's like having a giant mortgage at a super low interest rate, and if that rate jumps even just a little, the monthly payment goes up and you just can't afford to pay it anymore. Or option two, keep interest rates low so the government can keep borrowing, But that lets the value of the yen fall, and when the yen gets weaker, the cost of importing stuff gets a lot more expensive. So it's like having a low interest rate on your credit card, but every time you go shopping, everything costs more than it did last week, and the cost of living goes way up. So remember, the Bank of Japan already owns over 50% of the entire bond market, and they've been printing money for years just to keep that system going. But even with all of that control, it's not working as good anymore. Bond auctions are failing, and investors are walking away. They're asking for a higher interest to take on all of this economic risk. So Japan is asking a question that no government wants to ask, which is, how much longer can we pretend that this is sustainable? Because once you build a whole economy around cheap money, the moment you try to raise interest rates, the economy starts to break. And here's where I'm going to tie everything together, because this is where it gets really interesting. Because while all of this is playing out and Japan's bond market is breaking, interest payments are exploding, global debt is rising, inflation is creeping in, Bitcoin quietly reached an all-time high, and no one even noticed. Google searches are still extremely low, all things considering. Now, obviously, it's not just one thing. Bitcoin moves for a lot of different reasons, like ETFs, halving cycles, and businesses and states and countries buying it, but you can't ignore the big picture. The world is waking up to this idea that maybe those crazy Bitcoiners and what they've been saying since the beginning might actually be true, which is that this debt-based system might not be sustainable in the long term. And Japan is just one example. The US is not that far behind. And in both cases, the question becomes, how do you escape a system that only works when interest rates are close to zero? And the answer seems to be, you can't. There is no way out. Deep down, the market is starting to price in this idea that governments are not going to be able to grow their way out of this. They're not going to be able to raise taxes fast enough, and they will not cut spending because politicians just don't want to. None of them have the courage to face the public. And at the same time, we don't want to default. We don't want to not pay. The show must go on. So what's left? Facing the consequences, getting a credit downgrade, and inflating away the debt, devaluing the currency. Extend and pretend that everything is fine, and that's what Lynn Eldon meant with nothing stops this train. And if that's the direction we're going, even if it's slow, then it makes sense why people are buying things like Bitcoin. Because it's outside the system, it's finite, and it doesn't care about bond auctions, it doesn't care about tariffs, can't be printed into oblivion, and that's why I've been making it such a big part of my personal investment strategy. Again, I've been dollar cost averaging into it for a long time because this story makes a lot of sense to me, and I have no idea what my sell price is. I don't really have one. And the truth is, part of me really wants to take a big part of my stock portfolio and convert it into Bitcoin, but I don't think I'd sleep as comfortably, so I'm holding on to my stocks because even if all of this is wrong, then I can still rely on stocks to get me to retirement because that's what data shows works in the long term. I'm staying invested regardless of what happens though, but I did find this to be a really interesting story. I've got time to see how all of this plays out, but I'd love to hear your thoughts. As always, I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. I'd love to see you back here next week. I'll see you soon. Bye-bye.
The House just passed the One Big Beautiful Bill, and this bill is filled with massive changes to how Americans will be taxed. But there is one section in it that really caught my attention, and it's the real game changers for folks like us who are real estate buyers, builders, investors, and business owners. Starting next year, businesses might be able to deduct 100% of their equipment, vehicles, and even certain building expenses, we'll talk more about that in a little bit, in the very first year. This could even apply to folks with W-2 income. Now, get ready because this means that you will have a small window to jump on some of the craziest opportunities in real estate. In this video, I'm going to break down exactly what 100% bonus depreciation actually means, what's changing, who benefits, and what steps you should take before the Senate decides the final outcome. Let's start with the basics. Bonus depreciation is a tax incentive that allows businesses to immediately deduct a large percentage of the purchase price of eligible assets like machinery, vehicles, or even certain types of building improvements, instead of spreading that deduction over several years, which is often decades for us real estate investors. Now, under the 2017 Tax Cuts and Jobs Act, businesses could deduct 100% of their qualifying assets in the first year, but that began phasing out in 2023. Right now, it's only 40% in 2025, and it was scheduled to continue decreasing every year. But now, this new bill aims to reset that back to 100%, starting with assets purchased and placed into service after January 20th, 2025. This is a giant reset button for bonus depreciation. Now, here's the headline. If this bill becomes law, businesses would be allowed to claim 100% bonus depreciation on qualifying assets purchased and placed into service between January 20th, 2025 and December 31st, 2029. That's 5 more years of full upfront deductions on things like vehicles over 6,000 pounds, work-related equipment, furniture and fixtures for rentals, buildings and structures, land improvements like roads, fencing, and septic systems. And quite honestly, for real estate investors, that could mean tens or hundreds of thousands of dollars in tax write-offs in 1 year. This is essentially what Rob and I have been doing for the past several years, saving us millions of dollars in taxes. Now, the big question is, why is this important? Well, that's because cash flow is king at the end of the day. And when you can write off the entire cost of your improvements immediately, it reduces your taxable income and gives you more money to reinvest faster. Let me paint a picture. Imagine you're building a short-term rental on raw land. You spend $200,000 on a prefab or a kit home, $30,000 on infrastructure, and $20,000 furnishing and designing. If this bill passes, you could potentially write off all of that in the very first year. That's a potential $250,000 deduction, saving you upwards of $80,000 in taxes, depending on your income bracket. Now, this is absolutely huge for real estate developers, vacation rental owners, construction companies, and any businesses that have capital requirements. This new tax bill is incredibly powerful if you have a high income year coming up, or you're trying to offset gains from another investment. Okay, so what's the catch here? This bill has passed the House, which is a massive deal, but not the Senate yet. That means it's still up for debate. The Senate could make changes, delay it, or even stall it altogether. I think they're going to try to edit and tweak certain things in the bill, but I don't think they're going to outright just shut it down. But the fact that it passed the House with support, although it was really close, suggests that this does have momentum moving forward, especially heading into midterms where economic stimulus is a big talking point. We'll likely see a lot of movement and action on this over the next few weeks to months, and if passed, it would go into effect starting January 20th, 2025 for us real estate investors. Now, here's what I'm doing and what I would suggest that you do too. Number one is go talk to your accountant, your CPA, your tax strategist. Make sure you understand which assets you currently own or plan to buy that would qualify. If you don't happen to have a good tax strategist or accountant and you're looking for one, you should talk to my tax team that I've been working with for the last 20 years. I've got a great cost segregation company as well. All that just down in the description for you underneath this video. Second, you want to plan your 2025 investments. If you're considering building, buying, or expanding your business, get your ducks in a row now. And third, time your purchases, because like I said earlier, assets must be purchased and placed into service after January 20th, 2025 to qualify. The purchase and the install or the activation date matters. And then 4, watch legislation closely. Subscribe to updates, because if this passes, your 2025 strategy may change overnight and you could be sitting on several extra tens or hundreds of thousands of dollars. Now, if you've been on the fence about investing in your business or expanding your rental portfolio, this could be the green light that you've been waiting for. I know it is for a lot of us out here. The return of 100% bonus depreciation means tons of more flexibility, faster returns, and real-time tax savings for even if you are on a W-2 income. Again, I can't emphasize this enough. You'll want to speak with an expert tax strategist and accountant. I highly recommend my guy, Kevin. I'll leave his contact information down below. And now keep watching this closely and update you if the Senate moves it forward. Make sure you subscribe to the channel if you want updates like this. And drop a comment below if you want me to break down what qualifies or how to use the strategy for your own business. See you in the next one.
President Donald Trump's Liberation Day tariffs will remain in effect for now, despite Wednesday's ruling declaring them unlawful, as a federal appeals court ruled Thursday that the tariffs can stay while it deliberates on the case, though they could still be struck down later. That means Trump's Liberation Day tariffs will remain in place until at least June 9th, while the appeals court decides whether or not to uphold the Court of International Trade's ruling. The Trump administration asked for the tariffs to stay in effect while they appeal Wednesday's ruling, in which the Court of International Trade struck down Trump's sweeping April 2nd tariffs as being unlawful because the president didn't have the authority to impose sweeping tariffs under the law he used to justify them. While the tariffs are in effect for now, if an appeals court or the Supreme Court ultimately sides with the Court of International Trade and says they're unlawful, the Trump administration will have to refund any tariffs that it collects. The Federal Circuit could still ultimately decide Trump's tariffs are unlawful and should be struck down, or halted while the litigation moves forward, despite them siding with the president in Thursday's ruling. White House Press Secretary Carolyn Leavitt told reporters Thursday the Trump administration is pushing ahead with its tariff agenda, despite the Court of International Trade's ruling upending them. Leavitt said before the appeals court ruling that Trump officials are still holding trade negotiations with other countries to determine the final tariff rates the U.S. will impose on their imports, as the White House believes the Supreme Court or appeals court will ultimately uphold the Liberation Day tariffs. For more on this story, check out the article linked in the description.
Every quarter, Wall Street's biggest names, Warren Buffett, Seth Klarman, Bill Ackman, Monish Pabrai, Michael Burry and so on, quietly file one document that gives us a rare glimpse inside their portfolios. And just last week, we got the latest installment. So in this video, we're diving into the brand new 13F filings for Q1 of 2025. And as per usual, there are some seriously eyebrow-raising moves being made by the smart money right now. So with that said, here are the 5 most notable stories coming out of this quarter's 13F filings that you need to know about. And the first comes from the GOAT himself, Mr. Warren Buffett. While the main story of the quarter was how Buffett continued to struggle finding opportunities, growing his cash pile even further to $350 billion, there was a notable sell at the top of his portfolio, and that was in Bank of America. And this is quite significant. Bank of America has been one of Buffett's crown jewels ever since the aftermath of the GFC. To him, it's not just a holding, it's been a high conviction bet for well over a decade. As you can see, Bank of America has been Buffett's second largest holding since 2018, but over the past 3 quarters, he has been selling, and the company has now fallen to Berkshire's 4th largest position, occupying just 10% of the portfolio. So why the sell? Well, there are a few possible explanations, with the primary one being that he is simply de-risking. He's already exited names like Goldman Sachs and Wells Fargo in recent years, and even this quarter he was caught selling out of Citigroup and reducing his stake in Capital One. So given the current macro backdrop, higher interest rates, tightening credit conditions, and growing concerns about commercial real estate, Buffett might just be taking a more cautious stance on the financial sector more broadly. While banks often benefit from higher interest rates at first, that advantage can fade reasonably quickly. As borrowing costs rise, fewer people and businesses take out loans, that slows loan growth, and it hurts revenue. And then at the same time, the risk of defaults increases, especially among more vulnerable borrowers, forcing banks to set aside more for potential losses. So there are 2 reasons, and then the biggest red flag right now is arguably commercial real estate. So office buildings are still struggling with low occupancy, and many are facing refinancing at much higher rates, a recipe for defaults that could hit bank balance sheets hard. So it's not surprising that Buffett, ever the risk-conscious investor, is starting to step back. Add to that the fact that Bank of America shares had risen an eye-popping 88% from their late 2023 lows through early Q1. At the same time, the business itself was reporting only modest earnings growth, and you can see the logic. Buffett has always said he likes to buy when others are fearful and sell when others are greedy, and this may just be one of those moments. Okay, and that takes us into the second big news story of the quarter, and that is that Li Lu, the Chinese investor famously close with Charlie Munger, is also selling Bank of America. Li Lu is a very talented investor running Himalaya Capital, and not to flex too hard, but here I am with him a few years back. Yeah, he did answer a phone call during my photo op. But anyway, Bank of America is actually Li Lu's biggest position and has been a major part of his portfolio since Q1 of 2020. So the fact that he is now trimming, it's pretty significant. In fact, his sell-off was slightly more aggressive than Buffett's. He cut about 29% of the Bank of America position this quarter. But that wasn't the only eyebrow raiser in the latest 13F. Perhaps even more surprising was Li Lu's decision to cut his stake in Google by 19.47%, specifically the Class C shares. Now, that's interesting because while Bank of America is a cyclical financial stock sensitive to macro conditions, Google is a wide moat tech powerhouse, arguably one of the most durable compounders in the whole world. And Li Lu isn't known for making short-term bets. He's a Buffett-style investor through and through, focused on high-quality businesses he can hold for decades. So why the reduction? Well, there's no way to know for sure, but there are a few possibilities. One is simply portfolio concentration. As Google's stock surged over the past year, it may have grown too large a slice of the pie, prompting a bit of a rebalance. It's also worth noting that he holds Google A shares as well, and after the reduction in the C shares, both positions are now back to 17% of the portfolio each, so it could very well be a rebalancing situation. But another potential reason is that Li Lu, like Buffett and his Apple reduction, may be seeing warning signs around competition in the tech sector, particularly for Google, competition around large language models like OpenAI's ChatGPT. Now, although it may be several years away, many investors are already considering that AI models could very well disrupt the status quo in internet search, which in a worst case scenario could erode Google's moat and threaten the longer term future of the business. So that's certainly one possibility that could be going through Li Lu's mind. Or, let's not forget, this also could simply be him making an opportunistic trim after a big run up in the share price. You know, Google has climbed around 90% since its lows in late 2022, and that gain was as high as 137% during Q1. So for a disciplined value investor, that might have been his chance to lock in some gains. Whatever the reason, when someone as patient and as deliberate as Li Lu starts reducing exposure to names like Google, it is certainly worth watching closely, especially because not everyone is following suit. And that brings us to our third big move of the quarter. Seth Klarman is adding to his Google position. Seth Klarman runs the Baupost Group and is one of the few people that Warren Buffett has said that he'd feel comfortable trusting money with. So very, very high praise. And Seth has a long history with Google stock. It's been in his portfolio since Q1 of 2020, but since 2023, it's been right up there at the top as one of the dominant stocks in his portfolio. And well, in Q1, Seth certainly doubled down, adding 45% to the position, making this a $324 million position, occupying the number 2 spot in his portfolio at 9.33%. So that's not a small add, that's a bet. So while some investors are trimming and de-risking after a strong run up in tech, Klarman is definitely leaning in. And if I had to make a bet on this one too, I think I'd probably side more with Klarman. I mean, Google's moat is truly enormous, and their ad business is certainly not showing any signs of slowing down. Their revenue and net income charts are just consistently up and to the right, and they're investing heavily in AI to ensure that they can keep up with competitive threats. I think if they just weren't showing any inclination of incorporating AI into search, then sure, I would be worried, but that's just not the case. So I do think they'll keep posting solid performance as they have done year after year, and clearly, so does Seth. And that's the other thing about Google. We've been talking for a long time about how overpriced big tech is at the moment. But right now, because the stock has come down across Q1, Google currently sits with a PE ratio of 19, which isn't too crazy considering it's an absolute financial fortress. So Seth most certainly doubled down in that quarter. And that leads us to our fourth big news story of the 13Fs. This is a biggie. Bill Ackman making a sizable investment in Uber. Now, let me tell you, this was a big deal, not just because of the dollar amount, but because it's a brand new position for Pershing Square. And not just any new position, this one shot straight to the top of the portfolio, instantly becoming Ackman's largest holding, making up roughly 18.5% of his US stock portfolio. And I find this move is particularly interesting because he tends to run a highly concentrated portfolio, often sticking with just a handful of high conviction bets. So when he commits to a new name, especially one like Uber, which hasn't exactly had a smooth ride since going public, it signals real belief in the long-term thesis. On the 8th of February, Bill took to Twitter to say, quote, "Beginning in early January, we began acquiring a position in Uber. I've been a long-term customer and admirer of Uber, beginning when Edward Norton showed me the app in its early days. I was also fortunate to be a day one investor in the company through a small investment in a venture fund. While a great business, Uber has suffered from erratic management. Since he joined the company in 2017, Dara Khosrowshahi, CEO, has done a superb superb job in transforming the company into a highly profitable and cash-generative growth machine, we believe that Uber is one of the best managed and highest quality businesses in the world. Remarkably, it can still be purchased at a massive discount to intrinsic value. This favorable combination of attributes is extremely rare, particularly for a large cap company. Now, that is certainly a glowing review, and it's true. When looking at the numbers, the CEO has turned Uber into a business that finally generates cash as opposed to eating it. Now, I'm not very knowledgeable on Uber, so I don't really have any comment around the valuation side, but it's certainly clear that at a current PE of 16, Bill is interested in the long-term growth prospects. Over the last 5 years, they have grown revenue at 28% per year, and net income has shifted from negative 8.5 billion to now plus 9.8 billion as of their most recent annual report. So Bill definitely assuming this growth will continue. And it's worth noting, he already would have done pretty well in this position, as Uber has been on an absolute tear in recent months. In fact, from early January, which is when Bill said he started buying, up until today, the stock is up about 40%. So already a really solid call from Bill Ackman. But with that said, that leads us to one of the most newsworthy stories from this quarter's 13Fs. And that is the man himself, Dr. Michael Burry, selling practically his entire portfolio. And not just selling, but actually turning around and betting against many of the same stocks he held just 3 months earlier by opening put option positions. Now, I have made a full video on this already, so I'm not going to talk too much in depth about it here. If you want to watch that video, it will be coming up on screen for most devices right now. But the short of it is that at the end of last year, Burry had around $77 million invested across 13 holdings, many of them high conviction Chinese tech names like Alibaba, JD, Baidu, and Pinduoduo. But this quarter, his portfolio shrunk to just 13 million with only one stock left, Estee Lauder. Everything else was gone. But even more surprising, he didn't just exit, he actively bet against many of those same Chinese tech stocks using put options, as well as betting against high flyers like Nvidia and Trip.com. So what changed? Well, Burry's dramatic pivot seems to line up pretty perfectly with Trump's trade war with China. I think for Burry, these stocks went from recovery plays to geopolitical footballs, and Burry basically decided that the risk just simply wasn't worth it. Now, whether he still holds these positions, I should note, is anyone's guess. He's known to be a fast mover and act a little bit more like a short-term trader, but it was a massive shift in his 13F filing nonetheless. And with that said, they are the 13F filings this time around. One more thing, if you saw recently, I actually got to interview my investing mentor, Phil Town, but in that video, I announced that myself and Phil will be holding a live 3-day investing workshop later in the year in Atlanta, Georgia. It's going to be September 12th to 14th, and the best bit, it's going to be free entry. All you have to do is get yourself there. It will still be ticketed because we're maxed out at 300 people, so please, if you do want to go on the wait list, please check out the link in the description below and sign up. I will be emailing that list first before anyone else. So if you're interested, if you want to lock yourself in, please check out that link. But with that said, thanks very much for watching, guys. Please like the video if you enjoyed it. I'll see you guys in the next one.
So here I am. I made it to episode 20. This is supposed to be going to 100. That's the challenge. We'll see how far I make it with your help. How can you help? Subscribe. That at least tells me, tells the YouTubes, tell the algorithms, tell the gods and universes and everyone involved that I'm trying. I'm trying to do well. So back me up if you can. Thank you. Thank you. Weird, right?